This has probably happened to all of us. You're doing your equity research, you find a stock which you find very attractive, you find that they're trading at an attractive valuation, you see that they're growing their earnings, you see that they have a solid balance sheet, and you're ready to pull the trigger. And that same day, you decide a price range where you're comfortable actually buying or starting your position in this stock, and you look at the stock, surprise, the stock has risen over 10 or 15%, and now it's way higher than the price that you wanted to buy it at. So you usually think to yourself, the stock market is extremely volatile. Whenever this stock drops back to the price that I wanted, I'll buy it, and then I'll be able to own this high quality stock and add more to the position over time. The only problem is that this usually does not go our way. And what tends to happen during the following weeks or months is that this stock never touches our price. And in fact, it starts to rally right after we actually made the decision. This has happened to me countless of times. But why does this keep happening? And how can we wrap our heads around so that this doesn't happen to us? Well, before this video, I hadn't actually learned a solid mechanism to avoid this, which is why I decided to investigate. And I do have to say that from now on, I will approach investing in a different way and focus less on valuation. Because as Christopher Davis said, though tempting, trying to time the market is a loser's game. And by the way, for those of you that are curious, in this example, we're talking about none other than Palantir. This was their 1-year performance a couple of months ago when they were actually trading at all-time highs because they were going to be included into the S&P 500. And this is what happened to a lot of investors I know. And the thing is that we all have this ideal investing scenario which we want to execute over and over again in order to grow our capital and improve our portfolio. But the thing is that this investing scenario is a lot more rare than we think. Because of course we all know the theory behind it. You analyze a stock, you like their fundamentals, and you calculate its intrinsic value, which is the price at which its share should be trading at. Once you have this, you usually set a margin of safety to adjust for any errors in your calculations, for any macroeconomic changes, or in case your estimates are actually a lot more optimistic than what reality actually is. So this actually creates your entry price, where in theory, at any point below that, you should be buying the stock. And in this ideal investing scenario, of course, the moment you buy that stock below the entry price, it shoots up way above its fair value, giving you plenty of time and a lot of margin for you to sell, and then the stock manages to drop back down below the entry price, where you manage to scoop up even more shares and rinse and repeat the process by selling above its fair value, where of course this looks like easy money and it's a super simple process to replicate. And in the eyes of Howard Marks, this is the only intelligent form of investing, where you figure out what something's worth and then you see if you can buy it below that price. However, I have bad news. We don't live in the ideal world, and this is very rare to see, because there is one major complication that does not allow this same scenario to happen, which is that the fair value of a company, or its intrinsic value, is not static. It moves every single day. Just to make it easier to understand, here we have a graphic representation with Meta stock. Of course, this is a lot more simple than reality, because in reality it moves every single day, but it's just so that we understand and get the idea. You may have calculated the intrinsic value, and let's say he gave you that Meta should be trading at around $80 per share. Well, that's the intrinsic value with all the information you had available at that day. But there are a lot of things that happen that can alter the available information that you had. There may be rumors that Meta wants to buy TikTok. There may be news that Meta is going to be banned in Brazil, for example. Or Meta just had its latest earnings and reported a huge profitability increase that nobody was expecting. Well, in all of these occasions, the available information you had shifted, and that influenced the intrinsic value of the stock a lot. The market is constantly being flooded by different types of news, which constantly moves the price, but also the intrinsic value of different stocks. This is why one of Benjamin Graham's most famous quotes is true, where he says that in the short run, the market is a voting machine, but in the long run is a weighing machine. Because despite all of these news and rumors, at the end of the day, it's all about earnings, and these small fluctuations in price over 10-15 years are almost negligible. But of course, since we're emotional beings, it's very hard to ignore this when you're wanting to purchase some shares. One thing that I have seen is that valuation is actually not as important as we make it out to be. Over here we can see the annual stock market returns, but they're broken down into 3 components. First of all, it's dividends, second of all, it's earnings growth, and the third one is PE change. We can see that in the latest decade, the most important factor by far has been earnings growth. Out of the 13.6% annual stock market returns in this period, almost the entire of it can be attributed to companies managing to grow their earnings over this time. And we can see that the PE change only attributed 1 out of the 13% during this time period, meaning that the average multiple at the start of the decade was around the same as the average multiple at the end of the decade. And this is the same idea as we argued previously, that over the long term, stock price movements are heavily correlated with earnings growth. So this information is for you, well, and for myself, to actually understand that valuation, although important in the short term, over long periods of time is actually not that important. And again, as I always like to say, if you're investing, you should have a long time horizon, because the longer you invest for, the more likely it is that you will earn money. As we can see in the graph, if you've been holding stocks for around 1 year, there is a 76% probability that you will make money. However, if you've been holding stocks for 10, 20 years, there is between a 95% and a 100% probability of you earning money during this time. However, I do want to know if I'm buying at all-time highs or if I'm buying at a reasonable price. And there is one metric that I like to look at, and this is the free cash flow yield. Over here we have Amazon's price evolution for the past year. And in the US, companies report earnings 4 times a year. In these reports, they actually disclose all of the free cash flow that they've generated. Well, for the metric that I like to use, you have to have your 12th trailing month free cash flow, which is the sum of the latest 4-period free cash flow, and you divide that by the current market capitalization of the stock. This will give you a percentage, which is usually between 1, 2, and 3%. Now, the simple thing you have to look at is compare this ratio that you just got versus the expected rate of inflation, which is usually again between 2 and 3%. If you have a higher percentage, that in theory means that your company may be trading at a more attractive valuation. However, if your free cash flow yield is below the expected rate of inflation, that means that your company is probably overvalued. Of course, you can overcomplicate this by adding in different factors, such as removing stock-based compensation, but that would make this video too long. By understanding that, you have such of a price target where you are allowed to buy the stock anywhere below that, such as your fair value or entry price that we discussed previously. However, this tends to vary a lot less over time and a lot less with the earnings generation, as long as you've done your homework and the companies that you're researching have a very predictable free cash flow generation. And once you have that, you're ready to buy. So usually the best scenario in our non-ideal world and using this method would look something like this, where thanks to your free cash flow yield calculation, you have your acceptable entry price and you start a position on your stock right below that. As long as the company keeps trading underneath that free cash flow yield, you keep accumulating shares. Of course, since there is a lot of volatility on the market, and since the acceptable entry price will go up and down depending on the reported quarters, you will still have to buy on dips. There is one very important quote regarding this, which is by John Bogle. The 2 greatest enemies of the equity fund investor, but we can expand this to any type of investor, are expenses and emotions. But how do we get rid of emotions? The first 2 are the most important ones and the ones that help me the most. And don't get me wrong, I still haven't mastered this. This is a very tough process. But the first one is to develop a clear investment plan, which has limitations, and which in times of uncertainty, for example when the stock market has dropped 10-15%, indicate you how to behave in case you're becoming very emotional. And this goes hand in hand with number 2, which is to create a rule-based system. This is something that I usually like to write down because that makes it a lot more real and official. And you can write different rules, such as the ones that I have. For example, you should only buy companies that are trading below its free cash flow yield. You should never sell a company unless your investment thesis has changed. One of these rules for me is actually justify all of your decisions to yourself by writing down why you actually want to make that decision before actually executing it. So for example, if I want to buy some stock, I will first, of course, make a video to make sure that I'm actually 100% sure of what I'm about to do. Number 4 is to reduce your emotional stress. Not everyone can cope with a 50% decline in stock price values. I know I would be suffering a lot in those time periods, so it is a lot better to just understand your risk profile and reduce it so that it matches your emotional stress that you can handle. Number 5 is to limit checking price movements. This is very hard and I haven't mastered it yet. But in theory, if you're investing for the long term, you're an owner of a business. If you created your own business, you wouldn't have the price of the stock in front of you. You would just be focusing on watching it grow and seeing whether it's actually going in the right direction or not, rather than what the value of your shares are. And finally, number 6, the most important one, is to learn from mistakes. And this is the hardest point out of all these, but I think it's the one that helps the most. Thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.